Hi guys, my name is Dave. I'm the past guy, if you remember. I just wanted to draw your attention to what the results were for the past workshop times. I only put the announcement up Sunday night to give CUTV folks a chance to vote. Anyhow, the workshop times, you can find them in the discussion board. You go to discussion board, then click past and workshop time results. And here we have them. So they're Monday and Wednesday, 11:30 to 1. Loeb, one's in Loeb, one's in Patterson. So there they are, that's where to find them. And come on out, we had our first round of workshops this week. It was good, we did some financial statements, so hope to see you guys next week.
Hey, thanks a lot, Dave. Okay, so I have a few more announcements as well before we start into the material today. Those of you who are not familiar, and I keep getting emails about that, we do use WebCT a lot in this course. So I post my PowerPoint slides here, and I also scan the problems I've taken up in class, generally at the end of the day whenever I get back home. Course outline is here. I don't print it. I've been asked for that a few times, right? So print it yourself or just save an electronic copy of it, right? CNOW registration details. The CNOW opened today, yesterday rather, the quiz, and along with some practice problems. And I'll get into that shortly. You will need the course key. It's here, all right? And that's at some point during the registration process. This is not your first step, and I've been getting emails about that. Oh, I put in your course key as the first step. Your first piece of information that you need is the access code packaged with your textbook, all right? So use that first at some point during the process, and if you click on this, it'll tell you exactly where that process is. You have to enter in this course key. For technical support, two options. You can email somebody in Toronto, Lindsay Braddock at Nelson, or there's some online chat, and so just click on that link. Right? If you want the full guide, let me make this a bit bigger. If you want the full guide about CNOW, it's I think it's like 30 pages long. Click here. All right? It'll give you everything you need to know. All right? What else? Yeah, a number of people have been successful, by the way. I'm up at 52 students have actually registered for this course on My CNOW, so that's good. And it seems to be working. I've talked to a few people before class, and a lot of you are in. And I noticed last night a number of people have attempted their quiz. Okay. So online quiz is called CNOW, and I've also had a few questions about that. What do I mean? They open up every Wednesday, okay, shortly after midnight. So if you're keen, get right in there, right? 12:01, it's yours, all right? And you've got until the following Wednesday at 11:55 to actually click on something called submit, okay? You can attempt it 3 times. You can save your grades. You can do whatever, save your work rather, in order to get there, all right? So this is the student view. So once you get your CNOW account, this is what it should look like. There are 4 tabs across the top. All right? The course that you have registered for is going to be listed here. Any grades after you've pressed submit will be here. The actual assignment is in this area. Okay? So you'll notice that yesterday, if you were on, 2 things became available to you. Okay? One of them is the online quiz number 1. Covers chapter 4, and it does cover the material I'm covering in class that week, which is chapter 4. This one is 4 marks. Last week I had a few questions. People want some homework, some extra practice questions. I've put one here together. There are no marks here, but if you're struggling with the material in chapter 4, you think you need to practice a little bit more, here's some problems that you can do. Okay? So it tells me here that I have not taken it, but I do have 3 takes. Okay? You'll always have 3 takes at it. Okay? And you have unlimited time. Okay? So I'm going to go take that quiz. All right, so this will be your first take. You are limited to 3 takes. The assignment is due, just as I said, 11:55 the following Wednesday. Okay? And if your computer loses its connection, and I know sometimes that happens, especially with wireless connections, you will be able to resume if you return to the assignment within a few minutes. Okay? So we're going to start the assignment. So what does this tell you? It tells you there are 2 questions. Okay, 1 and 2. You are on question 1. All right? And these are sales-related transactions. Okay? And a lot of them are just drop-down menus. Okay? So I'm just going to go down here a little bit. So we sold some merchandise. The cost of that merchandise sold was $11,000. Okay? So we're given all of the information. Now, it's also telling you here, illustrate the effects of the accounts and financial statements of recording the following transactions. If no account, is, move this over here, because I've magnified my view. If no account or activity is affected, let me bring it back down. Let me bring this back. You have to be able to see the whole screen. If no effect, click on no effect anyway from the drop-down menu and leave the corresponding number entry box blank. Right? So if you sold merchandise, see how there's a drop-down menu here? Okay. And it's for cash. I know that cash is somehow affected. Okay. I know that merchandise is going down. Refresh my screen here. There. That's better. Oh, I just pressed F5 to refresh my screen. It wasn't showing me things. Okay. So, the other thing it's not showing here is no effect. There we go. And then you put the numbers in here. So, all right, so I got some cash, some merchandise goes down. All right. You also have to tell it what's going on here on the statement of cash flows. Right? So I will be introducing that today. We will actually do that. If you sell something, that is one of your operating activities. And here I am affecting the cash account, so I know that there is something going on here. And there'd be no effect here on the income statement. Okay. So I'll just say no effect going on there. All right. Oh, wait, is there? Yeah, there is, eh? Yeah, so, okay, retained earnings is actually going to go up. So you notice under shareholders' equity, it doesn't have sales. It just has, and expense accounts, it just has capital stock and retained earnings. Okay, so we know that, what is it, net income goes up by about 7,500? Yeah, there we go. So sales is going to go up, cost of merchandise sold. Oh yeah, and this is important too. Put in net income here. I know it sounds kind of redundant. Well, of course sales went up and your cost of your merchandise sold, but put all that into there too. There we go. All right, so that's how you do it. Just drop down menus. Where's my cursor? There we go. And so what you can do is actually before submit or even saving, you can check your work. All right, it's not going to give you any feedback as to why you're doing whatever you've done is wrong, but it'll put check marks on what you did right. Okay, so we did it right. Okay, thank you from whoever corrected me up above. We have all done it right. See where we haven't answered? We have little X's, all right? And it's just telling me that's incorrect. It's not telling me why. Anyway. But there is that ability to check your work. It's not considered one of your attempts, okay, or one of your tries, which is kind of nice. So that was the first question. If I want to then go to the second question, I just click there. Okay, there it comes. These are purchase transactions, all right? So we've got a purchase here of $18,000 of merchandise. So what's going on here? It's on account. The merchandise inventory, accounts payable. So just choose, what you think is being affected and put in the amount. Okay, if there's no effect, just leave it blank. What do we have here? 18,000. Right. And it could be, like here, there's no cash involved, and so, oops. I want to put in no effect here. In the income statement, all I've done is purchase some transactions, so there's been no effect here. All right. So let's say you get to this point, you're not done your second question, and Dragon's Den is on, and you want to go watch your show or whatever, or Glee is on, or whatever that you like to watch. You can press save, okay, and it will save your work up until that point. All right. And it's only after you're absolutely sure about what you'd like to do that you can actually press here, and this is a big one, so make assignment for grading. You can do this 3 times, all right? So I will submit for grading. Let's see what happens, all right? And it told me, oh, I didn't do too well, it's 60%. So it can actually take me to the results here, tell me what I did wrong, all right? So that next time, the next attempt, it'll tell me on the right and wrong. Oh, it's not telling me here exactly. It's just not giving the feedback I wanted here. I think it's under grades. Yeah. So, under grades, where is it? Usually you can click on it and get the reason why. Anyway, it's not popping up. It does on mine. Course. Times taken. I know it was doing this in another view for me. I was able to actually go in and get to know why I had gotten such a terrible mark. All right. So you can go in there and get some feedback. And I thought it was within grades, but I guess not. All right. Exactly. Yeah, it does take your best mark. That's the question. If you take it the 3 times, you actually press submit 3 times. Okay. It's not check your work, but submit. It will take your best mark. All right. So, any questions on See Now? Yeah. Check your work? Yeah, you click it at the top or the bottom, and it'll just put check marks on what you've done right, and X is what you've done wrong, but it won't tell you why. You get no hints. Okay. You only get that 3 times as well. So 3 times for check your work, 3 times for submitting, right? And it shouldn't take you 5 or 8 hours to complete these. These are relatively quick questions. There's just a few transactions in there, all right? I just want you to keep on track with the course, right? So this forces you to actually do some problems from Chapter 4 so you're better prepared for the future chapters. So let's keep on track here, okay? And I do drop the worst assignment mark, all right? The worst online quiz mark, rather. So there will be 9. I'm going to take your best 8. Right? So you have a bad week, or there's a million things due, at the end of October, and you just don't get around to it, or you do your online quiz poorly, don't worry about it, okay? No worries. Or you're sick, that can happen. Although, most people aren't sick for 8 days, You're able to function for at least a few days and get caught up. Okay. Any other questions on See Now? All right, so if you haven't already, get your account set up. Okay, lots of guides there, resources, technical support, online chat, email people. And there's also, I've noticed on the discussion board, quite a lot of people, telling us, where is it? It's under discussion. Yeah, somebody had some tips and tricks, anyway, that worked. Success. So, read these. Thank you, Michael McMartin, wherever you are. So this is how he worked it out. So, check this out. I've also posted on here in some of these discussion threads just, how to get some technical support. All right. So that was one of the announcements, actually. So in addition to PASS, the first See Now online quiz became available Wednesday, September 22nd, yesterday. It covers Chapter 4. That's what I'm going to be doing today. It's due next Wednesday at 11:55. Each Wednesday, a new quiz will become available. It will be due the following Wednesday. The quiz will cover the chapter that I take up in class that week. There will be no quiz available or due the week of October 21st, 27th. So you won't get one available on the 21st, and there will not be one due the 27th because of the midterm, October 29th. Then I had a question last week. I'm not quite sure if it was in class or by email. They have an electronic copy of the textbook, or they're renting it, or whatever, and they would like a See Now access code. Right? So you can buy that electronically as well. You can go onto the internet. And this is just how to go about doing that, okay? How to purchase that access code, right? Which is your first step, right, for your See Now. Any questions then? 100% for everybody, right? Yeah, of course. All right. Great. Okay, so where were we? We hadn't finished Chapter 3. All right. So I hope to finish this today, and I will finish Chapter 4, I promise. Did I say that last week? Anyway. So we just introduced accrual accounting, okay? Sometimes for revenue, you receive the cash in advance of actually providing the good or the service, or you might receive the cash afterward. And when is the time that you should actually record the revenue? So what we need there is some guidance, and the CICA handbook helps us with that. It says recognize revenue when performance is, actually it says substantially achieved. You've delivered the good or performed the service. The amount is reasonably measurable, and the collection of cash is reasonably assured. Right? So you need all three. Tick them off. So you receive the cash in advance. You have not delivered the good or the service. You can't record revenue just yet. Right? So there we go. So even though the cash might be received here on my timeline and the good or the service is provided here, all right, you don't record revenue until you get to this point here. All right. Another alternative here is you provide a good or the service, but you don't get the cash until later on. Okay? You still record the good or the service, the revenue at the time that the good or the service is provided. Okay? As long as you're reasonably assured you will actually get the cash eventually, record the revenue. Okay? What does accrual accounting say about expenses? All right. It says expense incurred. You record your expenses whenever they're incurred. Well, what that really means is we have to follow the matching concept. Okay? So whenever the expense, whenever the revenue pertaining to that expense is recorded. All right? Because we want to match our expenses to our revenues. That's what the matching principle says. So we might pay for something in advance of actually earning some revenue from that. Okay? So what's an example of that? So at the Horticultural Council, we've paid a deposit for our AGM that doesn't occur until March. All right? So we paid $2,000 a number of years ago, actually, about 2 years ago, to, where are we this year? At the West in Ottawa. We paid them a whole lot of money 2 years ago for an event that won't happen until March 2011. Okay? So what accrual accounting says is, even though I've paid the cash way in advance of actually having the event and earning the revenue there related to the event, I can't record the expense until March 2011. Okay? So there's revenue associated with our annual general meeting, or AGM. I can't record any of the expenses relating to the AGM until we actually record the revenue for the AGM. Right? So two things have got to go together. All right? Sometimes, though, you pay the cash after. So that's entirely possible. I'm not going to pay the West in Ottawa until the end of April, maybe even the beginning of May. We'll see. Okay. So I'm going to try to delay that just for cash purposes. So when do I record the expense? I still have to record the expense in March, right? Because that's when I earn my revenue. That's when I'm providing the service, what we do at the AGM, right? So that's what the matching principle says. You record the expense in the same period as the revenue that's giving rise to. Okay? So that's going to create a few different wrinkles here. All right? So we reviewed this. Julianne at her lemonade stand signed a contract to sell 50 glasses of lemonade. She's given $50 in advance. She can't record the revenue just yet. Okay? She is going to record that $50 in a special account. It's a liability account called unearned revenue. Okay? Remember, three things have to occur before she can actually record that revenue. Right? You have to know the amount, estimate it. You have to be reasonably assured of collection while she's received it. But the last one there, have to provide the good of the service. She hasn't done that. Okay? So cannot record the revenue just yet. She paid next month's rent. Now, here's something about accrual accounting with respect to expenses. She hasn't earned any money yet for next month's lemonade sales. Okay? She hasn't earned any of the revenues, so she's got to wait, okay, to actually record that expense until the revenue is earned. Right? So she's going to keep that expense on the asset part of the balance sheet under prepaid. Okay? So until she records the revenue pertaining to next month, this expense has got to be recorded as a prepaid expense. Here's another one, purchased equipment. All right. We're going to record equipment as an asset. Okay? And what we're going to see today is we don't expense that equipment until we start using it up and generating revenue, right? Because of the matching principle. Anyway, that's all I wanted to say. There we go. Mom gets another dividend. All right, so I think this is where we ended last week. All right, so if I summarize all of those transactions, what's going up or down, I get a new, what do they call this, integrated financial statement approach. That's what the textbook refers to it as. And I get new balances. And again, what's important to do at this point is just to make sure that my assets, total assets, equals the other side of the equation, right? Because we know that assets equals liabilities and equity. So just to check our work, just to make sure that we've done a good job here. The total on this side, I get 743. And on the other side, yeah, I get 743. All right, so all is good, right? There's an Italian monk that first demonstrated, the accounting equation, or wrote it down anyway, over 500 years ago. And he said, you can't go to bed at night until, well, he said debits and credits are in balance, but that's essentially what we're doing here, until your accounting equation is in balance. So we're good to go. All right. So what we are going to do now is actually adjust all of these accounts. Okay, so the month has gone on, October's gone on, a whole lot of transactions have occurred that we just covered, and now it's time, the end of October, to actually adjust all the accounts. All right, so we have to adjust our deferrals, and those were the transactions that were delayed the recognition of an expense. So Julianne had paid rent in advance. Okay. And she'd also received money in advance of the soccer tournament. And to make some accruals, okay, so what hasn't actually been recorded yet? Unrecorded wages, okay, or maybe there was some revenue not invoiced. Right? So it's time to adjust all those new accounts we saw. Prepaid rent, okay, unearned revenue. So first adjustment that we're going to make in this accrual process is to adjust the rent. Okay? So as prepaid rent expires, and what do I mean by that? As we start to actually receive the benefit of it and generate some revenue from it, the asset prepaid rent will decrease. Okay, so she had prepaid next month's rent. Okay, well, it's the end of the month now, of that month. We've used it up. Okay, so what we need to do is adjust the prepaid rent account. So that prepaid expense account has been used up, and it's going to go down, okay, by the $20. And now that she's received some revenue from that month, she can record the expense. Okay? That's what the matching principle is saying to us. Record the expense in the same period as the revenue that it gives rise to. Right. So I take a look at my analysis. Each side of the accounting equation is going down by the same amount, okay, minus 20. So we've adjusted that account. And that's the sort of process that I do every month in my other jobs, is take a look at the accounts and determine, does anything need to be adjusted here? Because I don't want to give an inaccurate picture to all of my users. All right? So before I actually send all the financial statements out, I generally do balance sheet and income statement at a minimum, if not more, type of reports. I want to make sure that everything's up to date. This is one of the sorts of expense entries I'll make. All right, she had bought some supplies. Remember, Juliana bought some supplies, and we had recorded it as an asset. Okay, and so now during this month, some supplies have been used up. Okay, so she's looked at all the supplies and said, oh, I've used a lot of the lemonade and the sugar and lemons or whatever, and so I've only got $55. So during November, $80 of supplies were used in operations, leaving a balance of $55. So what we have to do here is adjust our asset account where we had originally recorded it. Okay. Bring that down to by $80. And because I've used it up and obviously generated revenue from it, the matching principle says, okay, now that's an expense. Okay, so I'm going to call that supplies expense and decrease retained earnings as a result. That's another one. Oh, big one. Fixed assets and depreciation. Okay, so Julianne had bought a whole lot of equipment, right? Lemonade making supplies, some pitchers, some little cash box, a table, and whatnot. And that's got a very long life. Okay, it's not going to be consumed, within a few weeks. All right, it's used, as the slide says here, the equipment is used to generate revenue over time, and we want to show that. We want to show that we're using it up. Okay, all of its revenue generating ability, and we're going to have to record an expense. So it's a a special kind of expense called depreciation. Okay, I'm just going to record the fact that I've used some of this benefit that the equipment is giving me. It's generating revenue. Right? And I want to match, remember, my expenses, the equipment depreciation expense, to all the revenue over that equipment's useful life. Okay. So the depreciation on the equipment is calculated to be $10 a month. We're actually going to get into the calculation part of it later on in this course. But for now, I'm just going to tell you it's $10. Okay? So how do we record this? On the asset side of things, yeah, the equipment has been used up. Okay? We've benefited from its revenue generating ability. And actually what we're going to do is put the entry into a special account called accumulated depreciation. Right? So on the asset side of the balance sheet, we've got equipment, and that's where we had recorded all of these purchases that Julianne had made for her equipment. And then right below that on the balance sheet, we're going to specify the amount in our accumulated depreciation account. Okay. All right, so whatever it is, and we're going to subtract it. I forget what our equipment balance was. So let me go back. What is our equipment balance? It's 220. There we go. And I'm just going to subtract from this the balance now in my accumulated depreciation to get $210. Okay, so at this point in time, after I record the depreciation, on the balance sheet, things are going to look a little bit different. Okay? And we call this $210, could be called net book value or just carrying value, either term. Net book value or carrying value. And it's just what I'm carrying this equipment on, as on the financial statements on the balance sheet. Okay? So it's a special account. It's called a contra asset account, just meaning it's going against another account, in this case an asset account. Okay? So contra asset account is accumulated depreciation. Right? Right. And so what we're trying to do with depreciation is not try to come up with a market value for this equipment, but just show the fact that we're using it up. Okay? We're taking the cost of the equipment and using it up over its life, right? And so we're going to assign the cost of that equipment over its useful life. Okay? So it's not to say that the equipment now has a market value of $210. It's just to show that, yeah, we used up some of the value of that equipment. Okay? That's it. Right. So the other side of our analysis here has to do with depreciation expense under retained earnings. Okay? So we're bringing it down, retained earnings down by $10 by recording an expense. Now, we're not going to do this with all of our long-term assets, because there's a few long-term assets that we don't actually use up. Can anybody think of any? Land, exactly. Land does not get used up, right? So land isn't anything that there's less of in the future. So, and it it'll continue, of course, to generate revenue for it, but we're not going to show the fact that we're using it up or that it doesn't have a finite life, I guess is what I mean to say. Okay? So like some of the lemonade equipment, the pitchers and the glasses and the table that Julianne's bought, it's got a finite life because there will come a time when you can't use those glasses anymore, they'll break or whatnot. And we've tried to figure out, well, how long is the useful life? We'll take the cost of all of her equipment and depreciate it over its useful life, but things like land don't do that. Anything else? Can anybody think of anything else? More of an obscure topic. Some intangibles don't lose their value either. Okay? We're not going to depreciate goodwill. We'll get into that later on. We'll test for impairment, but that's another course. All right. Deferred revenue or unearned revenue. Okay, so Julianne, and that says, that's a typo. It shouldn't say rent. Unearned revenue. I don't know why I put rent in there. Okay, so we had recorded that $50 that she had gotten for a soccer tournament in an unearned revenue account. Okay. That is also sometimes referred to as deferred revenue, and that's why I put that in there. Okay, so on some balance sheets, if you're looking at some companies you're interested in, you might see the term deferred revenue. It means the same thing as unearned revenue. Okay, so there would be amounts that they've received, cash received for goods and services not yet provided. Okay, so that $50 for the soccer tournament was recorded as unearned revenue. During the month, the tournament's been held, and she provided the 50 glasses of lemonade. Okay, so now all three of those tests for revenue recognition we can tick off. Okay? We know the amount. Are we reasonably assured of collection? Yes. We've received the $50 already, and we've provided the good of the service. Okay, so what do? We're going to decrease liabilities because the unearned revenue has now been earned. Okay? We were liable to provide it before. We provided it. Done. And now we can recognize the sale, because all three of the revenue recognition tests have been fulfilled. Okay? We're all good. Oh, wrong way. All right. So we'll notice on this side of the accounting equation, a down and an up, which is good. Okay. Okay. So we're going to look at accruals now. Okay. At the end of any given month, I'm almost entirely positive that your employer owes you money that they have not yet paid you for. Okay? So you've earned some wages. Your employer probably has not paid you. You're not up to date. Okay? Because paydays occur when? Every 2 weeks? Twice a month for most people? Does anybody get paid every day? No, it doesn't happen. Okay? So you're on some sort of payroll schedule every 2 weeks. You get some money, all right? Check, bank account goes up. So at the end of a given month, though, your employer probably owes you money. Okay? So at that September the 30th, I know my employers owe me money. Okay? Because the payday for that pay period, okay, that was in the past hasn't occurred yet. So what we're going to do on our financial statements here is we want to show that, okay, that liability. At the same time, we want to show the expense. Yeah, we owe our employees some money. Okay. So, in Julianne's lemonade stand here, Julianne has not paid her sister yet her wages that are due at the end of the month. Okay. And we've calculated it out to be $10. Okay. So, she owes Marie $10. So, wages payable is going to go up. That's a liability account. Remember that word, payable? It's tipping us off. Yeah, that's a liability. And we're going to record expenses because Marie's done a whole lot of work for Julianne to give rise to revenue. Okay, so this does meet the test of an expense. Okay. What else? Another adjustment. Julianne provided lemonade of $50 to a company, and the company said, we'll pay you later. But she hasn't gotten around yet to invoicing them. Okay, and that's entirely possible. I know bookkeeping is often at the bottom of people's lists. As to what they'd like to do. So the customer owes Julianne money, and that meets the test, of course, of an account receivable. At the same time, all of the tests for revenue recognition here are satisfied. We know the amount. Okay, the good of the service has been performed. She's provided the glasses of lemonade, and let's hope that she's reasonably assured of collection. Okay, so if all of those three tests are met, we can record a sale. Okay, retained earnings is going to go up. All right, so let's summarize all of those adjusting transactions. Okay, so I'm going to do it on a spreadsheet. I'm getting tired of doing it on one sheet of paper, and then they're getting too big. That's part of the problem. Oh, let me like that. Chapter 3. No. Okay. There we go. So this was Julianne's. Am I in the right one? No, I'm on P3 too. There we go. Julianne's lemonade stand. Okay, so what I've done here is I've just put together an Excel spreadsheet, and maybe some of you have used Excel spreadsheets before. They're wonderful. They're great big tables that we can manipulate numbers with. Like it. So what I've done here on this line is just record the beginning balances in all of her asset accounts. Okay. And then as well in all of her liability and shareholders' equity accounts. Okay. All right, so what I did, my starting point here was that one slide. Okay. At the end, let me show you. There it is. Oh, slideshow, current slide. I took all the balances here, okay, after that first set of transactions, and I put them onto my spreadsheet. Okay, so cash has got a balance of $368. Supplies has a balance of $135. Okay. We prepaid rent at $20. And put them here. Okay. 368, 3520. All right. So that's all that I've done. So what I'd like to do now is just get these accounts up to date. Okay. Can you see that, or did you want it larger? Let's see about increasing the view. Make it just a bit bigger. There we go. All right. So the first adjusting journal entry, I'm calling them journal entries. This course is going to be hard for me. When I usually teach this course, I call these things journal entries. I'm going to call them adjusting transactions here. All right. Was for prepaid rent. Okay, so just going back to the PowerPoint here. Prepaid rent goes down by $20. Rent expense, we've got $20 there as well. Okay, so I'm just going to put minus 20 here. And then we had rent expense. And that's going to have the effect of reducing retained earnings, right, by $20. What I've asked the spreadsheet to do, too, is just to keep a running balance here at the bottom, okay, on this line here, so I know what the new balance is. Okay. All right, so that was my first adjusting entry. Second one was for supplies. She did a count. She realized she's used up some of her lemonade making supplies. So supplies are going down by 80, and supplies expense, $80 as well. So I go to adjustment number 2. Supplies is going to go down. Supplies expense, also going down. All right, next adjusting entry here was for the depreciation on her equipment. Okay, so something called accumulated depreciation going down by $10. Depreciation expense decreasing retained earnings by $10. Okay, so adjustment number 3, $10, and then that makes retained earnings go down by $10. Okay, let me just go over here. Right, so that's recorded. Next up was the unearned revenue. Okay, she actually provided now the glasses of lemonade at the soccer tournament, so we're going to reduce the unearned revenue account by $50 and then record a sale of $50. So that was 4. So that is going to go down by 50, and retained earnings goes up 50. What else happened? Oh yes, Julianne owes her sister. So we've got some wages payable, $10, and wages expense, $10. Now where is wages payable? Yeah, I've set that up. Oh, it's not. And that's an expense. Okay. And last adjusting journal entry, what was it? Oh yes, she provided lemonade, has not invoiced them yet. Okay. But we still want to show that sale somewhere here on the financial statements and the account receivable. So that's going up by 50. And that is going up by 50. All right. So this is the sort of format you're going to see often in this course. It comes back over and over and over again. Okay. And you'll also see this is the sort of format that you're going to need for your CNOW. Oh, you're Alex, right? Yeah, I taught you before. You had a question.
Okay, so accumulated depreciation only goes up because it's a credit. But since we're not dealing with that, is that why it's just a negative balance?
Yeah, it's got an effect of bringing down assets. Okay, so that's why I put negative here. Okay. Yeah. The other thing that we can see here is at the bottom of my spreadsheet, I'm keeping a running tabs here of what are my assets and what are my liabilities and equity in total. And I see that indeed, if it's programmed right into my spreadsheet. My assets balance, the total is 683. Liabilities and equity on the other side, 683. So we know that we've recorded them all correctly. Right? So this is very similar to the format that you're going to see repeatedly in the rest of this course that I'll be doing, and I'll probably be using spreadsheets, but also on CNOW. Okay, so the other additional thing that you're going to have to do with CNOW is anytime cash is affected, okay, so anything in this column, anytime we see something there, you're going to have to update, okay, let me just highlight that, something for the statement of cash flows, and that's generally on this side of cash flows. That's generally on this side that they ask you to identify, is that an increase or decrease in cash, and why? Is that operating operating activity, financing activity, or investing activity? Okay. And financing. Okay. And the other thing that you'll see on the CNOW is no effect. Okay. And that would be part of your pull-down menu. Okay. As to is that operating, investing, financing, or no effect. So it's only if cash is affected, and actually with all of these adjusting journal entries, you'll see that no cash has been affected. We just keep our balance at 368. So we would be saying no effect with each one of these transactions. But if you do have one, okay, for the CNOW assignment that's open there, the CNOW online quiz, operating is pertaining to basically revenues and expenses, like from regular line of business. Okay, so for Julianne, that's revenues and expenses pertaining to lemonade. Okay, so lemonade sales, lemonade expenses. Investing has to do with something we call capital assets, okay, or long-term assets. All right, so if you buy or sell them. Okay, so if the cash has got to do with the buying or selling of capital assets, you're going to say that's investing. Okay. Financing has to do with long-term liabilities and share capital. Okay, so if you issue bonds, you get money from a long-term loan, or you issue shares. And I realize these are subjects we haven't covered yet, but we will. Or repurchase of shares. Okay, that's going to go here. Dividends, I've seen it in financing and operating. So, is there a hard and fast rule there? No. I've taken a look at a lot of income statements, and I've seen it reported here and in operating. So if anything pertaining to cash affects any of these items, you're going to call it financing. Okay? But at this point in time, I can tell you that by and large, you're going to see operating. Okay? That's going to be probably the only thing that you're going to have to choose there, or no effect. Right? That's because that's all we've taken so far. Operating sales, okay, from lemonade, expenses pertaining to our lemonade business. And we haven't seen any buying or selling, or too much anyway, of capital assets, or issuing bonds or long-term loans. We haven't really gotten into that. We have a bit, I guess, with issuing shares. Yeah. Okay. The other part of this integrated framework thing that you're going to see on CNOW is a little space on this side of things under retained earnings for the income statement. Okay, so you're going to be given 3 drop-down menus, okay, generally to choose from. All right, and by and large, a lot of them will be how does that affect the income statement, and you'll be asked to choose between sales, expenses, and net income. Okay, so how do we know if we should be putting anything in here? Yeah, the last one is no effect. All right. You have to look at, remember this from last class, look at the activity in the retained earnings account. Okay, so a lot, where's my yellow? A lot going on here with retained earnings, meaning most likely my income statement is being affected here, if not dividends. Okay, so with this first one, minus 20, what were we doing there in that transaction? Adjustment number 1 had to do with the prepaid rent. Okay, so you would say that that has the effect of our expenses have gone up by $20. Okay. The second one was supplies have been used up. So you'd say that has the effect of expenses going up by $80 of supply expenses. So you just have to not just record the transaction, on this table here, but also just add a few more things on the left or the right. Okay, one pertaining to the statement of cash flows, another one to the income statement. Okay. Right. What I'm going to do is also post this spreadsheet, okay, onto the WebCT, okay, because it is something we've done in class. All right, so it'll be under course slides. And then if you haven't used Excel before, you will see Excel in action. Okay, so I'm bringing up my whole spreadsheet because I've frozen the titles. All right, so what do we do next? We've posted our adjusting journal entries. Julienne's Lemonade Stand, you know, we've got users who are keenly interested in the financial statements of Julienne's Lemonade Stand for this period. So what we can do now is that whole slate of financial statements. Okay. So what's always the first financial statement that we prepare? Income statement, right? Okay. So for the month ending, I forget, was this October, November? Anyway, say November. Is that working? Yes. Okay, so you've done a few income statements in class, you've done some in past, and so hopefully just the format of it is becoming clearer. Remember that you have to record sales first or show sales first under revenues. And actually, my income is coming from a few different spots here, so let me just go back here. I'm going to have to take a look at, you know, 2 different slides. So let me try to get this. Because these were transactions for the month of November as well. I think it was November, I can't remember. So I can use this. If I wanted to prepare my income statement, I know I have to go to the column that says retained earnings, and all of my items will be there, okay? Not just the income statement items, but also this was a dividend. That's another statement. I can't see that. There we go. So I had made some sales there, okay? Earlier on in the month, one for 150 and another one for 100. Okay, so I'm just pulling off those 2 amounts there. Oh, there we go. And I had also recorded some expenses on here, or some revenue on here. There it is. So I had recorded that unearned revenue, $50 from soccer tournament. I'd also recorded some revenue that I hadn't invoiced my company for. Okay. So I'm just taking amounts that are under the retained earnings column so I know what my total sales are. Okay. Expenses. Well, like I say, I had to go to 2 sheets. I've got some expenses, there we go, from my earlier transaction, okay, $40. And actually, in order to get the breakdown, I have to go to that column, that slide rather. There we go. Incurred expenses. Okay. So at that point, I had some wages. What are you, $4? I had some rent. 15. Advertising. And utilities. And I also had some expenses I had recorded here in that adjusting process. Okay, so $20 from my first adjustment, that was from rent, right? The prepaid rent that had expired. $80 there. That was from my second transaction, which I can't recall. What was that for? Oh, supplies. Right, so let me create another one there. There you go. And then there was $10. I remember that to be depreciation. What else belonged there? There was $10 in adjustment number 5. What was it? That was the wages. Right. There we go. So I think we've covered off all of them. Yeah, so we've got the revenue here, got the expenses from there, and some revenue here and expenses. I was highlighting them in green as we went along. So now I can just total them up. Oops, $10. So I've got total expenses then of $160. I'm running out of space. All right, so I'm going to bring that up. So what is my net income? $190. Oh, good for Julianne. All right, what's the next statement? Yeah, retained earnings, right. Okay, and again, you've done a few of these. We did some in class. I know you did some in PASS. So the format, you should be able to recall that just a little bit quicker, the second, third, fourth time that you do them. You need your beginning retained earnings balance. And I'm going to get that from my first summary here. So my retained earnings balance, oh, it's the $2 anyway. Okay, from the top. I'm going to add to that my net income. And how do I know my net income? Well, it's from the statement that I just did. And I'm going to subtract dividends, and I believe there was $4 here. I think that was it, eh? Is there any others? Nope. All right. A good check on your work, because I see that my retained earnings balance is 188. I've calculated that. But that it's also, I don't know if this will work, it's also here, okay, on that summary sheet, this integrated financial statement framework. Okay. So I must have done something right. Phew. All right, and the last statement is balance sheet. Right. Okay, so I'm going to bring that up. There we go. And it's really important that you have the right title, as at November 30th. All right. So at this point, I've updated the balances already. It was coming automatically here on my spreadsheet. And I'm just going to pull these balances off and put them onto my balance sheet. Okay? And we, like I say, we generally list them in order of liquidity. And I've already have them listed like that. So cash quite liquid. It's already cash. Accounts receivable. I'm going to start to use some abbreviations, only because I get really lazy up here. I'm going to call it A/R. All right, and that's fine. A lot of accountants use that. And you can put that on your midterm. I don't care. Put it on your final, and I'll know what it means. A/R stands for accounts receivable. Okay. So a few things like this that are absolutely fine to start abbreviating. Supplies is 55. Equipment, U220. Remember I said that actually this accumulated depreciation account goes right here, right on the face of the balance sheet. And we're going to just subtract it out. Generally on a financial statement, if we want to subtract something out, we put brackets around it, which is kind of odd, I know. Okay, so the rest of the world, mathematicians will put a negative. Yeah, we're going to subtract 10. Accountants just put brackets around the 10. Yeah, we're subtracting $10. All right, so total assets. Any questions so far? All still good? Yes. It's a contra asset account. We just want to keep track in a separate account all of the depreciation we've taken on the equipment. Okay? And we're going to do that right on the under assets. Okay? So this account just gets bigger and bigger over time. All right? It's $10 now, but next month we'll add another 10, keep going. All right, so that's one half of the balance sheet.
I have a question here.
Yeah.
The accumulated depreciation, I don't know how to word this question, but like, can you give me an example of another one that will have accumulated depreciation?
Okay, so cars, trucks, building, equipment.
So if we had a car, for example, I see like we have equipment 220 and then accumulation 10. Let's say they did the same as for a car. The car was 220, accumulation was 10. Would we post, for example, another car and then another accumulated depreciation?
Yeah, exactly. Okay, so Andrew's got a really good point. If you've got different large classes of assets like cars, equipment, you'd actually have two separate accumulated depreciation accounts for them. Yeah. This one just pertains to equipment. Okay? So you're not going to use the same account. This is just for equipment. Right? So at the Horticultural Council, I've got 4 of them because I've got 4 large, broad capital asset accounts. Okay, so I've got furniture and equipment. I've got computer, hardware and software. I've got building. What else do I have? I've got land. I also have intangibles. I've got a trademark. So I keep track of accumulated depreciation on furniture and equipment separately, okay, from the accumulated depreciation of the building. And they're actually reported on separately too in the financial statement. So if you go to the notes of any set of financial statements, okay, you'll actually see accumulated depreciation separate, a separate accumulated depreciation for each broad category. All right. So the other part of our balance sheet, liabilities and equity, we just list them. So I'm just going to move over around my spreadsheet here. I'm just pulling off the balances. Accounts payable. Oh yeah, another way to abbreviate accounts payable is to say A/P, and that's fine for you to put that on a midterm, on a final. You're in a rush. Don't worry. That's at 185. It's a bank loan. And capital stock is next. 100. There you go. So we're in balance. That's good. Don't ever send out a balance sheet that's not balanced. Okay, any questions on that set of financial statements? All good? Great. All right, so we've done the summary of transactions, we've done the financial statements. There we go. All right, so this is just a slide that demonstrates or shows the difference between cash and accrual basis. Okay, and there was a time where, you know, a lot of businesses just use the cash basis of accounting. So unless you actually received cash or paid cash, you did not record a revenue item or an expense item, right? The federal government was like this for many years. Okay, it was only in the 90s that this movement came underfoot that, hey, you know, the federal government, the government of Canada should show their books with a little bit of accrual accounting, all right? Still to this day, for tax purposes, there are some industries that can record everything on a cash basis. So, but a lot of people feel it's just not fair. You know, you've sold your lemonade, okay, you're virtually assured a collection. Why not record that as revenue? Okay. Or you've got an expense, you might have paid in advance. Why do we have to record this on our income statement? Okay, because we haven't received the benefit of it, hasn't given rise to generating revenue. So a lot of people feel that accrual accounting, okay, this accrual basis of accounting is showing the actual economic reality. Okay, better shows that. Okay, it shows more the revenue earned, okay, as the trends, you know, we're actually making sales. Right. All right, so yeah, more accurate measure of a company's performance. And that's why even the federal government has gone more to accrual-based accounting. All right, so this just demonstrates the accounting cycle. You identify your transactions, you record them in that big spreadsheet that I'm starting to show you. You record adjustments, so you bring up to date, you know, all your deferrals and your accruals. Okay, so check all those accounts out. And if there's anything missing, record it, and then prepare, you know, your financial statements. Okay. All right, so we're going to work on a problem from the book for Espresso Healthcare. Okay. They've a lot of transactions. Okay. So we're going to analyze and record the transactions for Espresso Healthcare using this textbook method, Integrated Financial Statement Framework. Record each transaction by date, and show the balance for each item after each transaction. The July 1st balances for the balance sheet are shown below. Okay, so on the next page here, I've got the scan of all the beginning balances. So you see how, as the chapters progress, it's getting wider and wider, okay, which is why I'm going to stop recording it here and show it on a spreadsheet. Yeah? It's at the back of the chapter. It's P31. Okay, so at the back of the chapter is usually an illustrative problem. I don't have the page exactly with me. There's a number of exercises, and then there'd be problems. Okay. So problem, under the problem section, it's P31. Okay. Okay, so just because it's getting very wide and unwieldy, you see that from the top of this slide, I'm going to put it into a spreadsheet again. Okay, it's getting too crazy. If I can get this back. No. All right. So I think this comes with the electronic version of the textbook. All of these problems, or even the student website, comes with a lot of the spreadsheets for problems already done up. Okay, and so that's where I got this from. Is simply somebody has already done it for me. I've put in, each of the opening balances onto a spreadsheet. Okay, just to make it that much simpler, because it just runs on and on and on. I'm just cursing over here to the other side, but it just keeps going on and on and on. And to put it onto a piece of paper like this, you won't be able to see it very well. Okay, so these have already been set up. If you go to this, I think even as a student, you get access to the student website supporting the textbook. It's there. All right. So, and they've already listed too. This is really nice of them. All of the dates that transactions occurred on. Right? So all you have to do is fill in the blanks. What I did is I went one step further. I've got the balances automatically recalculating. Okay, so kind of nice. So, what is it? The first transaction received $18,000 from Bradshaw Company as rent for the use of a vacant office in Espresso Healthcare's building. Bradshaw paid the rent 6 months in advance, which I have to say is rather unusual. Whenever you sign a lease, you pay first and last month's rent, but you're not going to pay your rent 6 months in advance. But you know, it's trying to illustrate a concept here. All right. So if I go to then my spreadsheet, you know what? Maybe what I'll do is I'll put this on the one side, because that's actually a scan of it as well. Not go in any more than that? There we go. Oh, thank you, whoever's up there, doing that for me. Okay, so I've printed out the slides so I can follow along. And then this can help us then update the spreadsheet here. Okay, so received $18,000 from Bradshaw Company for rent 6 months in advance. Bradshaw is not the company we're doing the books for. We're doing the books for Espresso Healthcare. So Espresso Healthcare owns this building, and they're renting out some space to Bradshaw Company. So, you know, eventually they'll earn the revenue on this. So how do I record this transaction here? What is going up and down on the assets, liabilities, and equity side? Yeah? Cash is going up. Right. And let me move that out of the way. And what did you say? Unearned revenue. Let's see if they've got one set up for that. So I'm just moving over here. Yes, they do. So there we go, $18,000. So I've increased both sides of the equation, all as well with the world. Okay. Because they have not earned this revenue, we're going to record it as a liability. They haven't provided that service yet. Okay, that's not going to happen until 6 months from now. The next transaction, let me just move over here, paid $4,200 for an insurance premium on a general business policy. Okay, so I don't think we've gotten into the details of insurance premiums just yet, but when do you pay insurance premiums, by the way? Anybody here pay insurance premiums? Do you pay after the insurance period is done or before? Before, yeah. So those of you who drive and pay exorbitant amounts for insurance, all right, you generally pay up front. Okay, so if you're paying, you know, your annual premium, it's for the period that's just beginning to start, or if you pay monthly, it's for the month that's just about to begin. All right. So the insurance premium on a general business policy, so they're paying up front, right? So how are we going to record this transaction here in this framework? Yes? Right. Right. So prepaid insurance is also going up. All right. And we see here that the way they formatted this spreadsheet is they put brackets around it, which is the accounting way of showing a negative number, right? So we learned that from the last income statement balance sheet there. Purchase supplies of $1,800 on account. How do we record that on our integrated framework? Yes, Sabrina. Yeah, and it is a payable because we see the word on account, right? So over here to the payables, there we go, 1,800. Okay. So the supplies haven't been used up. They sit on the asset part of the balance sheet. We have not paid it. We see the word on account. It's a liability. Okay. July the 9th, collected $17,500 for services provided to customers on account. So there's that word on account again, but this time it's in relation to customers. And they're collecting $17,500. How do we record this on the framework? Yeah? Right, there we go. Right, so customers on account, that's accounts receivable. That is going down. July 11th, paid creditors, $3,000 on account. Hit that word on account again, but now it's in relation to creditors, people we owe money to. Okay. So how do we record this on our integrated financial framework? Humongous spreadsheet. Sabrina. Right. Yeah, accounts payable was over on this side. That's going down. There you go. Invested an additional $50,000 in the business in exchange for capital stock. So that means somebody is investing $50,000. It's not being entirely clear. I'm assuming it's cash in the business in exchange for capital stock. So the business, again, not very clear here, but I'm assuming business is issuing stock certificates. We talked about that previous classes, and it's getting $50,000 cash from that shareholder, that new shareholder. Okay, so how do we record that transaction? Sometimes better to start with the obvious one. Which one is pretty obvious? Right? In what? In equity, yeah. So cash is going up. That's pretty obvious, so we know something else here has to change, and that's that capital stock, right? Okay. So we've run out of that page. I'm going to flip in my printout just so we can see it. There we go. So that was the next slide. July 20th. Good, we're there. Billed patients $49,000 for services provided, there we go again, on account. And so this is patients or customers on account means one thing as opposed to creditors on account. So what has changed here in the framework? Billed patients, yes. Right. Accounts receivable, customers owe us money, and? Yeah, because sales is going up, right? Or fees earned or whatever. Okay. July 25th, received $12,900 for services provided to customers who paid cash. So nothing about being on account. Some customers just pay cash. You can tell this is an American textbook, okay? So doctors providing services for cash? What's that? I haven't paid my doctor cash ever. But in the States, I guess, they don't have our healthcare system. They have to pay cash, $12,900. Okay, so we're going to go with the obvious one here. Cash is going up, $12,900. What's the other side of this transaction? Something else is changing. Anybody? We provided a service. Retained earnings, right. It meets the revenue recognition criteria. There we go. Then what happens? Paid expenses as follows. Wages, $24,000, utilities, et cetera, and paid it. That's the big word here. So what I'm going to do is just add all of those up, because I know that's in cash. $37,000. Oh, somebody's way ahead. Good. Alex? Somebody's up there. All right, $37,700. And what else has changed? Retained earnings, right? Because an expense, I'm just moving over here, has been paid. All right. Last transactions, paid dividends of $10,000 to stockholders. That would be Dr. Eversole. Okay, so paid, going to go with the obvious one. I know that one. Okay. To stockholders. What else?
It says in the previous slide that doctor, he's the sole stockholder, so he's like the sole proprietor of this company. Do you still take out of the cash account and like take out of the retained earnings? Do you take out of the retained earnings and go up by equity?
Yeah, so whenever you give any money to your shareholders, even if there's only one, and they're calling it dividends, you take it out of retained earnings. Okay. So.
Do you have to take it out of the cash account because
it's cash.
Okay.
Yeah. Yeah. So, that's sort of, understood when we see the word paid. And they're qualifying it as dividends. And for a company to actually pay a dividend, it has to be declared by the board of directors, approved by the board of directors. So, as soon as they say, yes, we declare a dividend and we're paying $10,000, and that we know comes out of retained earnings. Okay. He could also be paid a salary, but I'm not going to get into that. Okay. So have we done everything that was asked? We've recorded the July transactions using the integrated financial statement framework, record each transaction by date, show the balance. Well, I showed the balance at the end. And then they had given me the balances as shown below. Right. So that's good. Let me just do a check. Let me make sure. Oh, I knew that would happen. That's not wrong. Well, it's still showing crazy numbers. There's my total assets. I just want to make sure that what we've posted here is keeping our accounting equation in balance. Yes, yes. So we're good. All right. I'll just save that. Okay, the next slide. I don't want to keep flipping on the same thing. There we go. We've done P3-1, and now we're going to do P3-2. Okay, so at the end of your textbook, lots of problems. It's thank you, whoever's in the booth today. Who's up there? I don't know. Somebody up there. Thank you. All right. P3-2, we have adjustment data, which is similar to what we did here for Julianne's lemonade stand. Okay, so they are as follows. So based upon the transactions recorded in July for problem 3.1, record the adjustments for July using the integrated financial statement framework. So again, they've got a nice spreadsheet already done up. All right, and I'll just flip to that because that was really nice of them, and I will adjust these accounts now. Okay, insurance has expired, $800. How are we going to record that in this framework? Anybody? Half up? You know half of it?
Yeah. You got 800 from the paid insurance.
Yeah, yeah. So that much has expired, $800. So that's one. There's got to be another effect somewhere. Yes? Right, because it's insurance expense. So I'm just moving all the way over here. Expense reduces retained earnings. Okay, very good. Supplies on hand. July 31st. Let me just move back here. It says that it's $1,100, but if we take a look here in the account, the balance in the supplies account, it has $2,800. What we'd like to do, we've counted all the supplies, it's $1,100. We want to force it to become $1,100. Okay. All right, there we are. So if I want this balance to be $1,100, I'm going to have to subtract what? 1,700, right? See, look what we did. We just made the balance equal 1,100 here. Okay. So if I reduce supplies by 1,700, what else do I have to do? Supplies expense. I heard somebody whispering. So yeah, retained earnings is going to go down. And over here. Good. Next, adjusting entry. Depreciation on the building, 2,000. Accumulated depreciation, remember that? That's got the effect, and this was a question earlier, of reducing assets. So I'm actually going to put negative here, minus 2,000. And we know that depreciation is an expense as well. And that will bring retained earnings down by 2,000. Okay, number 4, unearned rent revenue earned, 3,000. So we had received all of that rent in advance. And so now they're saying, well, 3,000 of that is earned. So I'm going to reduce that balance by 3,000. Okay? And that means I've got revenue. Right? I've provided the good of the service, collected the money. I know the amount. So we're good to go. Wages owed employees but not paid, 1,700. I owe money. That's a liability. Okay, so I'm just over here. That's going up, 1,700. What's the other side to that transaction? Retained earnings, right. An expense has got the effect of reducing retained earnings. And last one, services provided but not yet billed to patients, $9,000. They owe us money. Accounts receivable is going up. Even though we haven't billed them, it doesn't mean that they don't owe us money. All right, so let's put that there. And that is a service that's been provided, meets the revenue recognition criteria, 9,000. Okay. So we have recorded the adjustments using the integrated financial statement framework. Okay. And then, of course, you can prepare financial statements, which we've already done. You know, that's not part of the requirements anyway. Any questions on adjusting entries? Right. So we've done that, and that, and that, and that's the end of chapter 3, but we're not done the class just yet. But it would be a good time for a break. So I have 10 o'clock right now. If we can come back at 10:15, I want to finish up chapter 4. Promise. All right, so welcome back. Hope you had a good break. I'll ask you to bring your conversations to a close, please. All right, that's great. Okay, so I will get through chapter 4 today. I'm not adhering to my schedule very well, but I promise. Your quiz is on chapter 4, so this is why I really want to get through chapter 4. Right, so I'll say you bring your conversations to a close. That's great. Okay, so what we're doing now is we've got building blocks, right? So we've talked about financial statements, transactions, adjusting entries, and accrual accounting. And let's see this actually in work in various industries. And one of them would be a merchandising business. So a place where you go buy things like groceries or a clothing store, or the university bookstore, or what have you. These are all merchandising companies, okay, merchandising business. Home Depot or Home Outfitters or what have you. You go to a mall, all of those stores, what we call merchandisers. Right? So we're going to look at their activities and financial statements. And we'll also look at their activities and financial statements. There we go. We're going to be looking at their transactions. So objective 3 there, describe the accounting for sale of merchandise and describe the accounting for purchase of merchandise, transportation costs, and then this dual nature of merchandising transactions, and then something called merchandise shrinkage. So you think you've got $100,000 worth of merchandise on the shelf, but you count it, you actually have 90,000. What's happened? All right. So that's what we call shrinkage. All right. So that is all the objectives from the chapter I will be covering. And just so you know, too, what I've done over the past week is put together a topical emphasis so that you know by chapter what I'm really focusing on. And you can sort of tell by my course slides. If I cover it, it's important. If I haven't mentioned it whatsoever, don't worry about it. Okay? So there was something in chapter 1, and I got an email about it. A student caught me on it and said, hey, but you didn't cover limited liability companies. What's up with that? Okay? And the reason why I didn't is that it's an American invention. It's not a Canadian thing. There's no equivalent Canadian type of company. We've got corporations, by and large. And a few other strange things called income trusts, but anyway, that's not part of the course. And so you'll notice in my topical emphasis when it talks about limited liability companies, I've got that, you know, as a level 4. I'm not going to cover that, all right? But I do cover most of the chapters. Chapter 5, I'm not covering a whole lot of that one. Okay, it's got to do with some American legislation called Sarbanes-Oxley. So I've taken all those learning objectives out of the slides for chapter 5. All right. All right. Okay, so let's just understand the difference between a service business and a merchandiser. Okay, so a lot of what we've covered in the problems from the textbook had to do with service businesses, right? So we did one on healthcare, right? It's in the States, that is a service business, they get revenue. And it's because they're providing service to a customer. For example, OC Transpo provides you with a service. They are a service type company. They're not selling you a good. Okay? Your doctor provides you with a service. They are a service company. Legal firms, accounting firms, okay, architectural firms provide services. IT support companies provide their services. All right? Consultants, all right, provide services. And that's their main line of business. So they're not selling you a good. Okay? Merchandise operations, yes, they buy and then they resell that merchandise. Okay? So Home Depot buys, you know, countertops and sinks and cabinetry and all sorts of things, and they resell it, okay, to people who walk into their store. The University Bookstore buys the books from Nelson Sungage and resells it to you. Okay? So they are what we call a merchandiser. You're buying goods from them. So a big Canadian merchandiser is Loblaw companies. Okay? And so what I've done is found their financial statements online. You can do this with any publicly traded company. Go online, check under investor relations, take a look at their income statement, balance sheet, see what's going on. Right? So this is Loblaw's companies. I've adapted the income statement to fit this format that we're looking at in this course. And generally, you're going to see two columns, too. That's the other neat thing. One for the current year, one for the last year. And so they've got, for the years ended January 2nd, 2010 and January 3rd, 2009. And that's the way it often is with a merchandiser. You really got to wonder, why are they doing this? Why isn't it not the same date for each one of the years? They take 52 weeks, okay? And they count that as a year, which, you know, that's the definition of a year. But they compare one 52-week period to another 52-week period. I see this time and again. And actually, January 2nd, 2010 is being reported there. January 3rd, 2009 is being reported there. All right? And this is what's called a multiple-step income statement, or multi-step income statement. It's not just listing like we have been doing, revenues altogether, expenses altogether. It's come up with various subtotals that users find important, they need to know. Right? So the first line, net sales. It's our first unusual difference here. And what that means is they must have subtracted something from sales. Okay, because you see that word net. Right? So what this is all of the sales that they've earned and generated, less any sales returns. You know, people can go back to Loblaws and say, oh, you know, this is bad, or this is not what I wanted, or this is in the wrong size, or what have you, and they call that a sales return. So they've subtracted it to get to this number. They might have offered somebody a discount, although I doubt it. But sometimes, just in the normal course of business, you might offer a sales discount, especially if you want to accelerate collection of your cash. So this number is after we record the sales discount. Right? And sales allowances is another thing that's subtracted here. So if you're still willing to buy something that's imperfect, you might ask for a little bit, you know, a discount off of it. We call that allowance. Okay, so take $10 off the price and you've got a deal, right? So that's what they've recorded here is sales less the sales discounts if they want people to pay early, and less returns, and less allowances. Okay, that's what's recorded in there, and that's why we see the word net. Okay, it's after subtracting something, a whole lot of things actually. Their next line is something that I don't think we've seen before in any of the examples or problems from the book, and it's cost of the merchandise sold. So Loblaws does sell a whole lot of merchandise every day. It adds up. And what was the cost of that merchandise that they sold? Okay. So, you know, they might buy that pound of bananas for 50 cents. Okay, they're selling it to you at 99 cents a pound, but that 50-cent cost to them, that's what they're recording here. And then on the next line, they've got something called gross profit. And what they've done is they've taken their net sales, in this case it's $30,735,000,000, subtracted off their cost of their merchandise sold in order to get gross profit. It's also called gross margin. Okay. You'll see that used interchangeably, those two terms. So $7,196,000,000. And this is of interest to the users. They want to know how much money do they have left now to pay for all their other expenses. Okay. And then they've got a category for operating expenses. Okay. And they've got it very much summarized, I have to say. It's not at all probably like what they use internally, but they've put selling and admin expenses here together, which is going to encompass a whole lot of types of expenses. So under selling, that could be the sales rep salaries, sales commissions, advertising expense, delivery expense, that sort of thing. And then admin staff salaries, the depreciation on admin equipment. Okay. Could be utilities for the head office even. Could be a whole lot of items that are going there under admin. Oh, and they've recorded depreciation amortization separately, so I guess that depreciation on admin equipment would go there. All right. So this is a line for total operating expenses. They've added that up. And then they derive something called operating income. Okay. So a lot more extra categories, more steps, right? That's why they call it the multiple step income statement. By and large, interest expense and interest income are always recorded on separate lines, okay? Because this is of prime importance for creditors. Remember, a lot of people using these financial statements, they want to get some information out of it. If you're the bank, you want to know exactly how much interest they have been paying, how much times interest have they earned. Okay, that's a ratio we're going to calculate later on. And just how big is their debt burden, you know. And so that's generally reported separately, and it's outside, it's after operating income. You want to see that reported separately. And then we've got another step, lots of steps, earnings before income taxes and other items. Income taxes are always shown separately, okay. That's their own. They're not lumped in together under operating expenses or anything else. Okay, so that's always reported separately. And again, that's for ratios. Okay, later on we'll take a look at where we back out income taxes. And then just some other items. And so what this means is it's not part of their operating activities. Okay, it's not part of their normal operations. And for Loblaws, of course, they're selling groceries, so they might have expenses or revenue that doesn't pertain to their grocery line. Okay, so they report that separately, and it's usually a smaller amount. Eh? We're only looking, for them, 11 million is small. So there's their net income. All right? So we do not see this revenue all lumped together and expenses all lumped together. Expenses especially, we see recorded in various steps. Okay? And that's for users' purposes. Okay? A lot of ratios that users are going to be calculating focus in on such things as operating income, interest expense, gross profit. They need to see these already calculated out, ready to go for their analysis. Okay? It's got to be there. Right. So yeah, there's some new terms, which I think I've covered. What are net sales? What is cost of merchandise sold? Oh yeah, another term for that is cost of goods sold. Okay, it means the same thing. What was the cost of the merchandise sold, or what was the cost of the goods that were sold? There we go. What is gross profit? Net sales less cost of merchandise sold. Operating expenses, expenses from the regular line of business, from operating activities. Okay. And it's grouped into selling expenses or admin expenses. Operating income, so how much, and this helps to determine too and assess, you know, from the regular operating line of activities, from the regular line of business. How much money did they make? Okay. Other income and expenses not related to primary operations. Interest income. They could have gains on sales of, you know, fixtures or equipment or whatnot. So let's just get into some of these terms just a little bit more deeply. We talked about that first term, net sales, how we subtracted out sales discounts. Okay? And I said, oh, that's to encourage people to pay more quickly. Right? So you offer credit terms to your customer. You say, okay, I'm going to sell you some merchandise. I'm going to issue you an invoice, okay, for $100. And generally we say, pay it within 30 days. That would be really nice. If you could pay me in 30 days, really good. But we might actually want to accelerate that even faster. Okay, by offering a sales discount, right? And so what you might see at the bottom of the invoice, if you can imagine, here's my invoice. Usually it's at the bottom, okay? Something will say terms. And right there, it'll tell you when is this due, and do you offer a discount or not. Right? So in this case, under terms, we've got some funny numbers, 2/10, comma, ends 30. So what that means is if you pay me in 10 days, you can take 2%, take a 2% discount off that invoice. And that accelerates, or we hope that accelerates, people paying quickly. Okay, so 2/10 would be take a 2% discount if the invoice is paid in 10 days. And that can be anything, too. You can see some people say, oh, 1/15 and 30. What would that mean then? Take a 1% discount if you pay in 15 days. All right. And still net 30. Net 30 is, I have to say, you're going to see that often. N30 or net 30 at the bottom of the invoice. That's generally most invoices that I've ever seen in all of my accounting career say that. They really want you to pay at least in 30 days. Okay? Don't go over it. Somebody's going to give you a phone call or an email or whatnot. If you don't take the discount, the entire amount here is due in 30 days. Okay? So that's what that means. Businesses need cash. I can tell you, like I've got 2 part-time jobs, and that's one of the first things I do is I check the cash position. Okay, so the bookkeepers have entered in entries, and I take a look at, well, what's the cash position today? Because I'm always forecasting out. Okay, that's one of my main jobs as a controller at the Hort Council and manager of finance at the Agricultural Institute, is do I have enough cash to pay for my payroll, my suppliers? Okay, what about that big purchase next month of a new server or whatnot? Always forecasting that out. Not even formally, just writing it down on a piece of paper, like, do I have enough money? And if I can get my customers to pay faster, I'm a lot happier. Right? If I can collect outstanding receivables, very happy. So this is one of the ways to do that. Okay? Quickly get the cash back in the door here. You need cash in order to survive. Okay, so there are 2 methods of accounting for inventory and conversely your cost of merchandise sold or your cost of goods sold. And so one of them is called the periodic inventory system, which means you're just adjusting the balance of your inventory at least once a year or periodically. Okay? So you actually don't know at any given moment what your inventory is like until you do your count. I mean, you can walk up and down the aisles and say, yeah, the shelves look full, you know, and I think I've got so much in inventory here. But you don't actually adjust it. You don't have a good number, a reliable number. You can say yes with any certainty, that's how much inventory I've got. And that's more the, I find more and more these days, the older system that is being used to track inventory costs, the periodic. Now that we've got computers everywhere and accounting packages are cheap, I can tell you that, Simply Accounting is very cheap. A few $100s, you too can have a perpetual inventory system, meaning you're going to be keeping a running total of your inventory and your cost of goods sold or your cost of merchandise sold. Okay? So you can get accurate, up-to-date information immediately. Okay? So yeah, you can walk up and down the aisles and do a little mental math. Okay, I think I've got so much. But with a perpetual inventory system, you know, it's pretty bang on. But you're still going to want to do an inventory count, right? Anybody here work in retail? Got to be a few. Yes, have you done inventory counts? Yeah? Okay. Long and boring, yeah. So what do you do with an inventory count?
You have this machine you go around and scan all the barcodes.
And then do you scan the barcode of every item that's on the shelf? And it counts it that way?
There's duplicates of that same item.
Okay.
You just put a number in, but yeah, most time you have to go through every single item and scan the barcode and pays for it.
Forever, yeah. So generally, is the store closed or the aisle is closed?
Yeah.
The whole store is closed.
I don't work in retail anymore, but
Yeah.
the store's closed and you go overnight.
You do it overnight. Anybody else do an inventory count? There's a few. No? But sometimes they'll just close down the aisle. But then you've got that, you know, things might be sold right after you count them, and it's really not an accurate count. But at least you get a more up-to-date number. Even a perpetual inventory system, you're going to have an inventory count. Because what can happen? Theft, yeah. So if you've worked in retail, you understand the importance. Yes, there's a lot of theft, right? There could be errors, too, that are made. You know, somebody types in the wrong, you know, the barcode isn't scanning at the cash, and they type something in that's not exactly perfect. And so your system, your accounting system is has errors in it. Okay. So that's why you actually want to do an actual inventory count. And you're going to do that in a perpetual system too, just to make sure that your accounting system is up to date and is reliable. So in the periodic inventory system, let me just expand on that just a little bit, and that's all I'm going to say on it, is if you wanted to know what is your new cost of goods sold at the end of the period, this is where you take your, you would have done an inventory count at the beginning of, well, it's usually a year, okay? And you do a count at the end, your ending inventory here. All right. And this is how you would calculate your cost of merchandise sold, is you've got those two count numbers, you know the cost of your opening inventory, you know the cost of your ending inventory, and you track purchases, okay, throughout the year, or it could also be month and quarter, but anyway. By and large, people do this just once a year. It's expensive, you know, you have to hire all this staff to do all this boring counting, you know, so you're not going to do this every month. Right? So you keep track of purchases in a separate account, and you compare your counts at the beginning to the end, and that's how you would calculate your cost of merchandise sold. Right? So opening inventory plus net purchases less ending inventory. Right? So that means you're only going to get that cost of merchandise number once a year. Right? Imagine preparing an income statement mid-year. You're going to have to do some sort of estimating. Okay? And this is why we don't see periodic inventory system used very often. It's because you don't get some numbers that you critically need. Okay? So, you know, let's take a look here at Loblaws. Oh, it's all messy. If they don't know the cost of their merchandise sold, they'll never know how much income that they've made, their net income. Right? So it becomes really hard. They can estimate, I mean, there are tools there, estimate cost of merchandise sold, right, using certain percentages, historical percentages, but it's not the same as a perpetual inventory system where this is kept up to date all the time. Okay, so we'll also take a look at Loblaw's balance sheet. Okay, so again, as at the 52 weeks ending, 2010, 2009, or what they're referring to as 09, 08. And so the important difference to note here is that they've got actually a line for inventory, okay, which is their cost of the items that remain on the shelves. Okay. So let's take a look at some transactions, okay, that Loblaws might have had, okay, over the last year. Okay. So Loblaws sells merchandise for $200 cash. The cost of this merchandise was $150. The effect on the accounting equation. So what do we know for sure that's happened? Actually, two things have actually happened that we want to record. The first is the sale. Okay, so cash has gone up by $200. Sales, which increases retained earnings, that's gone up by $200. The other part of it here is the merchandise that's been sold. Okay, so we know now inventory is going down by $150, and one of those special expense accounts, cost of merchandise sold, has reduced retained earnings by $150. Okay. So this is assuming that Loblaws uses a perpetual inventory system, and that's what I'm going to assume throughout the textbook for this chapter. Okay, and that's what the textbook does too. Okay, because I have to say, by and large, you know, accounting systems track this sort of thing for you. Okay, it's very rare to actually go into a business that doesn't scan barcodes anymore. Okay, so you're going to see somebody scanning a barcode and it comes up. That means they're probably using a perpetual inventory system. Okay. And that gives them a lot more information than ever. They know exactly, or they should know, exactly how many textbooks that they've got on hand, you know, survey of accounting in the university bookstore. They can tell you. Or you can go into chapters, eh? Do you ever go to their little kiosks? You're looking for a book, and they tell you, oh, there's 2 of that one by Malcolm Gladwell, and it's over here. Now, how would they know that? Well, they've got a perpetual accounting system, an inventory system that's telling them, okay, that's where you can go get that book by Gladwell over there. Okay. So then they keep their balance sheet up to date and their income statement up to date as a result. Okay. All right, so sales transactions can also be on account, although I challenge any of you, walk into Loblaws and say, I'll pay you later. See how that goes. Do you think they go for that? No. All right, but let's say, in my made-up world here, that Loblaws sells merchandise for $200 on account with terms 2, 10, and 30. We know what those mean. take a 2% discount if you pay in 10 days. Otherwise, pay the whole thing, please, in 30 days. The cost of this merchandise was $150. The only thing that's changing here in my analysis is accounts receivables going up instead of cash. Sales have gone up, okay, or retained earnings. Merchandise inventory gone down, which has the effect of reducing retained earnings, cost of merchandise sold by 150. Okay. So these are very similar transactions to what you're going to see on the See Now. Okay. Remember at the beginning of the lecture today, this is very similar, and you could just go through, identify the accounts. The other thing that you're going to have to enter in is on this side, statement of cash flows, and on this side for income statement. Okay. So has cash gone up or down here? No, no cash. I do not see any cash. So what did I just do? I put my hand on the screen and this is what happened. So what you're going to put down here is no effect. Okay? It's only if cash is going up or down that you've actually affected the statement of cash flows. Under income statement, you're going to have some drop-down boxes here too. And you're going to show three things on the income statement side of things. You're going to drop down and find sales, and you're going to say, yeah, that's gone up by $200. You're going to drop down and say, cost of merchandise sold, 150. I don't know if you can see that. And the last thing, because there's actually 3 lines after this one, is you're going to say net income has gone up by $50. It's not showing anyway, 50. And it's not writing where I want it to write anyway. So you're showing the effect of this transaction on the income statement. Okay, that's what the See Now is prompting you to do, right? On this last slide, I'm going to go back just one slide here, where the sale was for cash, right? So under this part of the See Now assignment, you're going to have the statement of cash flows. And this part, somewhat below, and to the right is income statement. Here, cash has been affected, but you have to actually quantify under what category. So is this operating, investing, or financing? Operating, right? From that regular line of business, right? Right, it's operating. Income statement would be the same. Okay, sales going up 200, cost of merchandise sold 150, net income 50. Right, so keep that in mind for your See Now assignment, your online quiz. All right, next slide. That last sale that we just made, $200, the customer pays within the discount period of 10 days and therefore is entitled to a 2% discount off the $200 invoice. That's $4. Loblaws receives only $196. Okay? But they're happier, you know. This is good for them. They get the cash in the door. You don't want to be running low on cash. It's not a way to run a business. So it's easy to identify the change here in cash. They said you've received $196, so that's going up. This is to settle an account that your customer has of $200. So your accounts receivable is going up $200. That's fairly straightforward. What's not so straightforward is that sales discount. Okay, so sales discounts, remember that is used to calculate your net sales. And if it's going to bring down net sales, that's going to bring down retained earnings. Right? You know that they're all related. So if I take a look on this side of my accounting equation, it goes down by -4. This one goes down by -4. I'm good. Decreasing each side by $4. Okay. Now, sometimes customers are given a special price reduction or sales allowance. You know, it's not quite perfect. You know, it's not exactly the color you want, but you'll buy it if they take off some money. Okay. Or they might return some merchandise. Okay. So how do we record that? So let's say it's a $100 return in this case. We're going to reduce accounts receivable or cash by 100. Depends on the sale, right? So if it was made on account, accounts receivable goes down. If it was something they've already paid for, you're going to reimburse them the cash of $100. Okay? And on the other side, we've got that special account again that we we're looking at to calculate net sales, sales returns and allowances. Okay, that has the effect of reducing sales, which reduces retained earnings. All right, so there's a problem that we can do. The following selected transactions were completed by Tropical Supplies Company, which sells supplies primarily to wholesalers and occasionally to retail customers. So sold merchandise on account, it received a check, issued a credit memorandum, a lot of things. So illustrate the effects of each of the preceding transactions on the accounts and financial statements of Tropical Supplies Company. Identify each transaction by date. Well, maybe I can put it on here. Let's see. Shouldn't be that many accounts. The last one there with the last problem we were doing. Need to fix that. Thank you. Wherever you are. Can I do just a bit more? There we go. Perfect. Okay. All right, so there's one side of the accounting equation and the other. Sold merchandise on account, $8,000. So we see that word on account, okay, and we're selling it, which means we're offering our customers some credit terms. We said pay later, okay. The cost of the merchandise was $6,000. So under the asset side of things, my accounts receivable is going up, and I am using A/R because I don't want to keep writing that out. That's crazy. That's going up by $8,000. I'm going to record the sale part first, and then I'll record the cost of the merchandise. Okay. So retained earnings will have also gone up by $8,000. And then now I'll record the merchandise sold. All right, $6,000. So inventory is going down. The cost of the merchandise sold reduces retained earnings by $6,000. Okay, that's a cost of merchandise sold is a type of expense, right? Now, if I was doing this on CNOW, I've got a little area over here that says statement of cash flows. There's no effect, right? I'm just going to do this verbally. I don't have room to write it all out because cash hasn't been affected. Okay, so statement of cash flows, nothing. On this side of the CNOW screen, you're going to see income statement. Okay, so you have to record the sale, the cost of the merchandise sold, and they also want you to put in something for net income. Okay, so put in $2,000 there, net income. And actually, I think on CNOW you just record the net. You just put 2,000 here. There you go. Okay. Oh yeah, there's some terms on here that we haven't covered yet. N/EOM. Okay, that means it's due at the end of the month. And I actually have never seen this used in any invoice I have ever seen, and I had to look it up because I've never even seen this in a textbook. Anyway, so I find that really odd that somebody would have that as credit terms. It's due at the end of the month. But what if you sold it on the 29th, right? Is it due on the 30th? Anyway, ridiculous. And I'm going to cover this FOB terms later on. All right, we'll talk about that. Sold merchandise on account, $20,000. Terms FOB destination. I'll get to that later. But here are the terms, 1, 10, and 30. Okay? The cost of the merchandise was $14,000. All right, so it's on account again. So accounts receivable is going up 20,000, and sales goes up by 20,000. Right? Cost of the merchandise is 14,000. So inventory going down by 14. Cost of merchandise sold reduces retained earnings. Okay. The statement of cash flow is not affected, no effect. Income statement, we've got sales, cost of merchandise sold, and actually what you'd put onto CNOW is $6,000 here, net income. Okay. January 16th, sold merchandise on account again. Here we go again. $12,000. Terms FOB shipping point, I'll talk about later. Terms 1, 10, and 30. All right. So all very similar. 12,000. The cost of the merchandise is 7,200. So yeah, actually on C now they're going to want you just to subtract those out and show net income of 48. Okay. So the 12 minus 7,200. On January the 18th, received check for the amount due for the sale on January the 8th. Okay, that's this one here. And it is the 18th. Can they take the discount? Do they get the discount? Yes, they get the discount. The discount is 1% because they're paying within 10 days. Okay. So I'm going to just put this on another piece of paper. So you had issued a $20,000 invoice on January the 8th. They're paying within 10 days, so they get a 1% discount. Is that $200? So the amount of the check is going to be $19,800. Okay? So that's what's going on January the 18th. Received check for the amount due for the sale on January 18th. Okay? So, let's go here. I'm receiving then $19,800 in cash. Oh, I need another column for that. Oh, I'll put it over here. Oh, getting very unwieldy. Cash is going up by $19,800. Anything else changing? Yeah? Yeah. For the 20 though, we want to show that this is in payment of an invoice that had a total amount of $20,000. So something's not balancing here. Where else do I need? Right. So my sales discounts reduces, right, retained earnings. So if you're doing this on C now, this has affected now the statement of cash flows. And I know it's hard to see, but I have created another column here for cash. Just pretend it's over here. So this is from operating activities, $19,800. And for the income statement, you want to show that retained earnings or sales discounts has reduced retained earnings by $200. All right. All right. On the 19th, issued a credit memorandum for $3,000 for merchandise returned from the sale. Which one is this? On January the 16th. Okay, so there's a return here. They bought merchandise worth $12,000. They returned $3,000. Okay. Oh, I don't want that. All right. So the merchandise is coming back in. A lot of things are happening. On the asset side of things, we've got, and that's, I'll make columns here so it all fits. Cash isn't being affected, but accounts receivable certainly has. If this sale was originally on account, okay, and you're issuing a credit memorandum, which means you're reducing the amount from their invoice, of the amount that they owe, okay, from that original invoice. So you're actually reducing accounts receivable by $3,000. Okay, and I'm going to just record the other side here of the $3,000. It's under retained earnings. But that sales returns and allowances account will be affected, okay, for that merchandise return. And now let's update the inventory. The cost of the merchandise returned was $1,800. Okay, so inventory is actually going to go back up, right? They're going to put it back on the shelves if it's okay to put it back on the shelf. And then at the same time, their retained earnings is going to go up because their cost of the merchandise sold, it's going to decrease. That has the effect of increasing retained earnings, right? That's why it's plus. Okay. So, two things. The credit memorandum decreases accounts receivable, We've got a sales return and allowance, which decreases retained earnings. Yeah, that's why we have got the minus. The cost of the merchandise, well, the inventory is going to go back up again. You're going to restock your shelves with it. It's going to reduce cost of merchandise sold, which actually increases, right, retained earnings. Cost of merchandise sold is like an expense account. Right? So if we're decreasing it, we're going to increase retained earnings. Great. Next up, receive the check for the amount due for the sale on January the 16th. So let's go back. That sale, January the 16th, was for $12,000. Okay. On January the 19th, right, they returned $3,000. Oh, I'm going to have to put this on a separate piece of paper. So, we made a sale on January the 16th. Oops. Of $12,000. And what were the terms we have here? 110 and 30. They then returned some on the 19th. 3,000. Okay. What else has happened? On January the 26th, they pay up. Are they going to pay $9,000 or do they get the 1% discount? Yeah, they get the discount. What is that, 90? 8,910? Right. So that's how much cash they're going to get to settle the account receivable of $9,000. Okay? Because they are paying within the discount period. So they do get the 1% discount. So, can you see that? Yep. January 16th, at this point we want to show that accounts receivable is going down by 9,000. We are getting cash of 8,910. Well, that doesn't balance. So what's missing? The discount, yeah. So here we go again. Retained earnings will go down by $90. Okay. Just bring that down. Good. Paid Gallatin Delivery Service $1,500 for merchandise delivered during January to customers under shipping terms of FOB destination. And I haven't covered that yet. Apologize. All that means is that they have to pay for the delivery. Okay. Oh, this is the 26th. Sorry. 34. So they're paying something. Cash is going down. Okay. And they have a delivery type expense, okay, a selling expense. Of $1,500. All right. Received a check for the amount due on the sale of January the 2nd. Well, I don't think there was any credit terms on that one. I'll just back up. No, just due at the end of the month. That's good. So they're receiving cash of $8,000, and their accounts receivable goes down by $8,000. No discount on that one. Okay, so this is very similar to the problem we have to do on C now. Okay, except, of course, you've got the cash flow thing to update and the net income, the statement of income statement, anyway, to update at the same time. Right. Any questions on this problem? Good. All right, let's look at the other types of transactions you're going to see in a merchandiser. These were all selling transactions, sales transactions. The merchandisers also have to get in their merchandise somehow by purchasing it. Okay? And we're going to assume perpetual system throughout the chapter. Okay? So when a merchandise is purchased in a company that uses a perpetual inventory system, The purchase can actually be recorded two ways. Okay. If it's paid in cash, we're going to decrease cash and increase inventory. If it's purchased on account, we see that word keep happening. It means cash hasn't exchanged hands, and accounts payable is actually going to go up. All right, so two options there. Either paid cash or you bought it on account. Either way, inventory is going up. Okay. Doesn't matter what system you know, paid cash or on account, your inventory is going to go up. Okay. Purchase discounts. And here's that mirror image going on. As a purchaser, you might be sold goods with some discount terms if you pay early. Okay? So, if you're the buyer, you're paying early, and you've got discount terms of 4, 15, and 30, and you do pay within 15 days, that means you'd pay $6 less, 4% of $150. How are you going to show this then in your accounting system? You're actually going to show that discount as a reduction in your inventory. Okay? It's actually what you didn't have to pay for your inventory. Okay? Cash is going to go down by $144, and it's to settle an account payable of $150. So that's what's happening there. There's that mirror image again. As the buyer, you might also want to return some merchandise or ask for an allowance. Okay, something's wrong, there's a scratch on it, whatnot. So Loblaws returns merchandise worth $50 back to their supplier. How do they account for that? Inventory goes down, okay, and they get a reduction of their account payable. Now, I told you I'd talk about these terms later on, so here we are. What does FOB destination mean? Well, FOB rather, stands for freight on board, which in and of itself probably means nothing. But it's the terms after that that determine who's going to pay for the shipping. Or the delivery of the goods, that delivery charge. Somebody's got to pay this trucking company or the truck driver, okay? So FOB destination point means the transaction doesn't occur, there's no sale or purchase until it reaches its destination. And see that word destination? Transaction doesn't occur until it gets to its destination. So title passes at the buyer's shop. Okay, that's what we're trying to say here. So the seller is responsible for inventory while it's in transit. They're going to pay for the delivery charge. They're going to pay for insurance, customs brokerage if it's got to cross over a border. Okay? Whatever. They pay for all of the costs while in transit. The other one, FOB shipping point, what does that mean? Means that the transaction occurs when it's shipped. Just outside of the seller's warehouse here, that's when the title is passing. So if you're the buyer, you pay for shipping, insurance, customs brokerage, what have you, any cost incurred to get it to your store. So that sale transaction, the purchase transaction recorded as soon as it's shipped out, as soon as it leaves the door. Okay. How do we account for those transportation costs as the buyer? Okay. Well, we refer to as freight in or transportation in. And what it's going to do at the end of the day, it's going to increase inventory. Okay, we're going to add it to the cost of the inventory. Because there's this accounting concept out there that says actually for any asset account, whatever the cost of the merchandise is, or any cost to set up that merchandise and get it working for you, or any asset getting working for you, you get to add to your asset account. Right? So if you had to pay for the transportation, add it to your asset account. Right. Sales tax, that's something else that could happen here. All right, so we all know in Ontario we pay 13% on virtually everything. Okay, there's not too much that's zero rated for HST. Okay, groceries, prescription drugs, the only two that I can think of off the top of my head. So you have a sale for $100, 13% GST, HST rather, will be added to that. So what a company will do that's selling you merchandise is charge you $113. They still record it only as a sale of $100 on their books. That $13 becomes a liability to them. Right? They will remit that money to CRA, the Canada Revenue Agency, later on, monthly, quarterly, annually, depending on their filing frequency. Whenever they do pay it, there we go, liabilities will go down. Okay, one last problem, very similar to your See Now assignment. Aren't you glad I'm doing this? Aren't you glad you came to class? You get to see what this is on their See Now assignment. It's very similar. These are purchase transactions for Silvergate Company during May of the current year. So they bought merchandise, they pay freight, they pay their invoices. Illustrate the effects of each of the preceding transactions on the accounting frameworky thing. Okay. So, May 3rd, we're to identify them all. I'll set up some accounts here, make my columns nicer. Accounts payable, that's A/P. And then I've got retained earnings here under equity. All right, so if I purchase merchandise for $16,000, terms FOB destination, that means actually the transaction doesn't occur until it's delivered, with terms 210 and 30. First of all, did they pay cash or is this on account? Did they pay cash? How do we know? We see those terms, eh? We see 210 and 30. So that means somebody's issued an invoice. This is on account. Okay. So that means accounts payable will be going up. Okay, we bought merchandise inventory, right? Merchandise, inventory is going up. All right, May 6th. Issued a debit memorandum for $4,000 of merchandise returned from the purchase on May the 3rd. Okay. What's a debit memorandum? We've heard about the credit memorandum earlier, right? When we were issuing invoices ourselves for sales. Here, this is a debit memorandum. Means our accounts payable is going to go down. Because we're returning some merchandise, so inventory also goes down. Okay? And for both of these transactions, there's absolutely no effect on the statement of cash flows, because there's nothing there. And there's no effect on the income statement, because there's nothing here. Okay? No effect. The 10th. Purchased merchandise, terms FOB shipping point, net end of month, EOM. Again, if when we see these terms, it's on account. So that looks very similar to what we saw before. Inventory will go up, accounts payable is going up. Okay. Paid freight on the May 10th purchase. Okay, so I'm paying freight, so I know cash is going down. Where's the other part of the transaction here? The inventory, yeah. Any cost to get that inventory, or any asset actually, up and being useful to you gets to be recorded in the asset account, in this case inventory. Remember, it was FOB shipping point. You as the buyer are responsible for that from the point that it's shipped outside the warehouse. 13th of May, paid for the invoice on May the 3rd. Okay, so that was $16,000. It's May the 13th. And if I do remember, on May the 3rd, I'm just backing up here, it was 210 and 30. So I am paying within the discount period. Okay, so I'm going to get 2% off of that if I pay, and I am. Less the debit memorandum of May the 6th. Oh, lots going on. Let me just... So May 13th, we got an invoice for $16,000. Okay. We returned some of that on May the 6th, sorry, for $4,000. We owe our supplier $12,000. We're paying within the discount period, so we get a 2% discount. That's $240. What is that? $760? All right. So it means we're only going to be, when they say paying the invoice, we'll be paying $11,760. So cash is going down 11,760. It's to pay for accounts payable of 12,000. Something's not quite right here. Where do I record the difference of 240? Purchase returns and allowance? It is a purchase return allowance, but I'm using a perpetual inventory system, so where does that get recorded? Inventory. Right. Somebody said purchase returns and allowances. That is actually an account that we are going to use had we been using periodic inventory system. Okay, so you're not far off, but and they haven't said it here, but this chapter does assume perpetual. Okay. So purchase returns and allowances right into inventory. May 31st, paid for the invoice from May the 10th. Okay, that's easy. Cash goes down and accounts payable. Okay. The last topic is about merchandise shrinkage. So you've got this fancy accounting system. You scan everything that comes into the building and leaves the building. So as you purchase it, you put it into your system, your accounting system or your inventory system. As people buy the inventory, you scan it out. Errors can be made. Okay. Oh no. People can steal things. You don't want that to happen. And when I say steal, it's employees and shoplifters too can happen. So what you're going to want to do is, as you actually count your inventory, compare it to what your records say. Okay? And in this case, the record said 63,950. Your count, unfortunately, was only 62,150. So you've lost somewhere along the way, $1,800. Okay? How do you record that? Pretty obvious. You have to record the change here in your inventory account. But on the other side of things, record it as cost of merchandise sold. Okay. All right, and that is the end of the chapter. I'm finally on time. All right, have a good week. Good luck with your See Now online quiz. Bye.